happy to be here again. Professor Benoon has always been very warm and welcoming to me, and it's great to be at NYU. It's also great to have the opportunity to exchange a bunch of views with you guys. I'm somewhat of a bear, I guess, and I can't decide whether that's because of my natural predisposition after being in China for 20 years, or whether it's warranted by what's going on right now. But my background is really a China one. My dissertation was on the People's Bank. I got into banking because I didn't know anything about banks of any kind. I couldn't see a career writing about something I didn't understand, and I was really fortunate in a series of events in China to have done the first IPO out of the country in 1992, first New York listing in '94, and then a series of other restructurings and IPOs as an investment banker working for Credit Suisse at that time. Well, everybody gets disintermediated at some point, and then I went to join Morgan Stanley, worked for CICC, and helped run that joint venture, which I'm sure you've heard about. And I get disintermediated again. The Premier's son stands up and says he's going to be the one. You've got no choice. You've got to move on. So for years, I joined JP Morgan again, which used to be Killen's Bank, which is where I started. And then ran the China platform, trying to expand the platform both in terms of commercial banking, but also securities. We finally set up a securities JV, which I didn't really agree with, and a trust investment, which I really did agree with, and it's making tons of money right now. So that's my last 30 years basically. I have somewhat of an outsider's view on how the financial system works, but the books I've written have both been translated into Chinese in the mainland and are available there for people to read. Only Right Capitalism was slightly expurgated, and I didn't care anyway. So tonight, we're not going to make any money selling books in China. So tonight I've got 20 minutes to talk about something that's really complicated and you guys are all involved in it one way or the other. I wanted to do a really quick look at the banks and where they're at and what I think about them, and then talk about their bond portfolios, interest rates, gaming accounting, and which is what I think this is all about, and finally just some implications of what all this might mean. So we've got 10 slides more or less. I just went through the outline of the comments on page 2. So one of the things I'm looking at now is banks and the budget. So I just out of curiosity, I wanted to know how much capital to liabilities China's banking system has had and has now. And so you can get this kind of data from PBOC. You don't know how it's been compiled. It's not risk adjusted. It's just data. So, but if you put it like this, you can see in the 50s they really had a problem with their data. As over the last 30 years, data has gotten, at least for the banking system, I think, gotten a little bit better on a macro basis. And you can see right now they've got about, for the entire financial system, including insurance companies and commercial banks, and I guess securities companies as well, they've got about 2 cents for every dollar of liability. So this is a very highly leveraged financial system. And if you look at the next page, you can see how in 5 short years China's total banking assets doubled total banking system in the United States. This time, if there is a problem loan problem in China, it is not going to be resolved by the economy growing like blazes for 10 years like it did last time. The economy is not growing. People say 7% is great, but 7%, of course 7% is good when you mandate it from Beijing. Who knows what the economy is really going at? I hate to be a nattering nabob, but I do think once the problem loans really become publicly recognized better than they are now, and it's just starting finally, then they're going to really have a problem to deal with it. If you look at the next page, it's the total social financing trends. This kind of data which shows new credit on an annual basis. Only started by the PBOC in 2002. I think Charlene Chu at Fitch had a lot to do with this because she started putting out a similar kind of data range back then. And I think the PBOC adopted that. Well, you can see you've got new credit, total credit, growing at over 30% of GDP clip for quite some time now. I had thought that Xi Jinping and the new government might start to reel this in, but the problem is the economy lives on credit. If you don't have credit, there is not going to be growth. And as we were discussing earlier, it is not return on capital in China that's important, it's job creation. So when we really think about GDP growth, what this is trying to do is maintain job creation in the country. Nonetheless, you have a huge bulge in credit. If you look at the next page, look at the total banking assets by type of bank, and you can see the CAGR since 2005 has been astounding for the banks that should at least be able to withstand this kind of a credit extension. The city commercial banks, which are owned by local municipal governments, have grown at a CAGR of 29% a year. That is, to me, just unbelievable. At the same time, these are the guys that issue most of the wealth management products. I looked at, not last year, but 2013, I looked through a data sample. I didn't get the values of the wealth management products issued, but this data gave the names of the issuers of wealth management products, and 80% on a name basis were these city commercial banks. And I guarantee you, I lived in that country for 20 years, and I had no idea where some of these places are. So you look at the CAGR there, or the shareholding banks, which are slightly larger and owned by provincial governments. The state banks, which are listed, as we all know, so much slower. And then the policy banks, which I believe are China's biggest asset management companies, especially China Development Bank. These are totally non-transparent institutions funded through bond issuances held by the commercial banks. And if you go through the management discussion of the annual reports of the commercial banks, the big five, you will see the top 10 in their bond portfolios are all policy bank bonds. So instead of what you really have here is, instead of the national budget sponsoring infrastructure projects or investments, what you really have is the commercial banks buying the bonds of CDB, Agricultural Development Bank, which then make the investments. To me, it's not quite the same. If you have the banks do it, you really have to expect some kind of repayment at some point. If your tax base is doing it, it doesn't matter so much. But China suffers from a tremendously weak tax base. We look at the next.
You worry more about shareholders than you do about taxpayers.
The only people who really pay taxes on time in China are the foreigners, okay? I paid a lot, and I'm still working, 4 years later, I'm still working off my foreigner income tax. Foreign institutions pay through the nose over there, let me tell you. Local tax offices love them. If you look at the big four banks on page 6, their asset composition. This is where I want to start thinking about the bond portfolios. These banks have also doubled their balance sheet in the last 5 years, and 20% of their balance sheet, or their total assets, are these bond portfolios. I think anyway, and I could be out of it, but most people, when they talk about bad loans and so on in the press or elsewhere, are really talking about the loan portfolios. Nobody says anything about the bond portfolios. So tonight I wanted to talk a little bit about these things. And if you turn the page, you'll see the fruit of my labor going through 6,000 entries in a spreadsheet from Wind Information. So I sorted them out by who were the issuers. This is for 2015. And what were their credit ratings. So it shouldn't be surprising to you that...
Is this by number or value?
Not value. This is just by number.
And so you got this book Wind?
Wind. Yep. Wind has everything.
Is any of it in English?
No.
Sure.
But you can buy it here. You can get it in the States. I should make a disclosure here. Fraser Howey, my co-author, is the only human being who's a non-corporate individual who owns a subscription to Wind. This is where all this comes from. So, but he doesn't sort it. I sort it because I'm obsessive. And he's a trader. So, So if you could just look at the issuers, they're all large SOEs. Public companies, I also believe, are all SOEs. They may have a minority shareholder interest. I don't believe in anybody down in Shenzhen on the exchange down there who are small privately owned, who supposedly are small and privately owned, are issuers of these bonds. So it's not surprising they have high credit ratings. And of course, I should mention that
Whose credit ratings are those?
these are all domestic credit ratings. This is totally domestic bonds, and the state owns the credit ratings. We'll get to that in a second. Now, if you look at the yields, the bond yields on these loans, on the loans versus the bonds, you'll see there's a 200 basis point plus difference. And I included in there these old asset management company or bad bank bonds, which the bank put on their balance sheet. So you can see that they're basically paying the Ministry of Finance 2.25, I'm sorry, PBOC, central bank, 2.25% a year. The bonds are 100 basis points above that, or a little bit less. And then you have loans. If you look at bank loan portfolios, about 60% of them are enterprise loans. Of these, state enterprise loans have been declining steadily for about 2/3 in '95 to about 1/3 in 2012. So the decline in the SOE loans are being partially offset by this tremendous explosion in bond issuance over the last 3 or 4 years, which has all been promoted by the PBOC. So one implication of this is that the enterprise loan...
Just to clarify, the
Sure.
225 is the rate on bonds issued by the PBOC?
By the asset management companies.
By the asset
Yeah.
management? And then the 311 is the rate on government bonds?
No, these are corporate bonds. And the loans are corporate bonds. Now, where was I? So my one comment I have on this is, as the SOE loans migrate to and included in that, the financing platforms that local governments have used to raise money, as these migrate out, you have less creditworthy enterprise loan portfolios. Of course, another big chunk of bank loan portfolios are mortgage loans and individual loans to individuals. And one final point here, as you look and consider interest rates on these various assets, if you go back through the management discussion of the Hong Kong listed banks annual reports, you'll see an awful lot of risk management products being discussed. There's a lot of derivatives flying back and forth in renminbi in China. But I can guarantee you that since foreigners only hold less than 2% of financial assets in China, these are being traded among themselves, among each other. And if we look at the next page, my shell game, all of these guys are owned by, have the same controlling shareholder, namely the state. So from my point of view, what you really have here is whether it's the bond portfolio itself, and there's almost no credit provisions made for it because they're all extremely high rated, nor is there any real interest rate risk protection afforded to any of banks, the financial system, by the risk management products that have been developed in the last 4 or 5 years. So if you look at my shell game here, we've got a state owner, we've got banks, we've got the central bank, and you look down below, the Ministry of Finance management accounts are accounts that hold the bad loans of ICBC and also Agricultural Bank of China. The multiple regulators for bank bond portfolios include PBOC, NDRC, CBRC, the China Banking Regulatory Commission, and something called NAFMI, which is the National Association of Financial Market Institutional Intermediaries, which is staffed by a bunch of Sijang from the PBOC, department heads from the PBOC, and an NGO that regulates the issuance of medium-term notes and commercial paper. Wealth management products, we know, are basically unregulated. Policy banks are not audited, and the AMCs, aside from Cinda, I read their 700-page IPO prospectus. I did not emerge enlightened. None of this, except for the big 4 or 5 banks, including the Bank of Communications, are really semi-transparent. So you have a financial system that began to evolve towards something that we might recognize 10 years ago, and then got caught up in the global financial crisis and was used for policy reasons to support GDP growth and employment, and now has been transformed into basically these are not commercial banks anymore. They are policy banks, just like the China Development Bank. So if I were to be asked, okay, how much of a problem do you think it might be? I mean, this is anybody's guess. But I want to try and, the point I want to make out of this is that if you're conservative about the stock of bonds and loans and wealth management products and say 5%, then you come up with non-performers of around 1.1 trillion RMB. And if the AMCs can pay 34 cents on the dollar for each of these things, and the bank loss, somebody has to take a loss, is around 700 billion yuan. Then I just look at the total banking assets by bank type, or total bank capital. You really see that the shareholding banks and the small-sized banks really don't have much capital in this game. And if they're the ones that are going to have to take the hit by selling these things to asset management companies, whether national or whether the 4 locally owned asset management companies, then they're really going to have a hard time raising capital. And local governments are least able, as we all know, to pay for this. So another question is, can the state really manage this kind of a problem? So I just want to wrap it up. I guess my big point is you can't look at these, although the banks are audited on an individual basis, you can't look at them individually. You have to think about the government as a consolidated whole, and it's very difficult to do that. That's for sure. And even if you look at the Chinese state, it is not a federal state, it is a unitary state. So in theory, Beijing is on the hook for all the provincial governments and below. But in fact, it's not entirely clear that that is the case. So who owns the banks and who's going to be on the hook for these problems is not entirely clear to me, although I believe that Beijing ultimately will have to step in. Other implications, I never have believed in interest rate reform or in currency reform, and I haven't seen it yet. I'm amazingly surprised by the PBOC's announcement that deposit insurance is going to be enacted or put in, implemented on the beginning of May 1st. Nice national holiday to kick it off. This is something that's been going on for 8 years. All of us who incorporated our local branches in China were told to do so because we could not take retail deposits unless we had depositors insurance, and therefore you had to be locally incorporated to be able to participate in the program. The program never materialized. However, they did regulate us like local banks, which was a new experience for me. So I think you're going to see it will not be the kind of reforms people talk about. There'll be declining transparency in the whole thing. And I think increasing, one thing you will see is a tremendous amount of pressure put on the central bank to begin disgorging, as it has started to, the deposit reserves, which I think total around $3 billion right now, and lending them out, allowing the banks to make new loans with them. Because if you really look, I wasn't able to show you the maturity profile of these bonds because I didn't get the 2013 data until it was too late to do. If you look at that, then you can really see that the bonds issued by local governments were used to take out their loans. So those are my comments.